Doing your taxes is definitely not the most glamorous part of running a business. So it's easy to push it to the back burner until tax season. But if you're a small business owner looking to minimize your costs, pocket more of those profits, and invest them back into your business, you need a proper tax plan that goes beyond tax season. That said, we understand that running a business or businesses means you already have a lot on your hands. So, to simplify things for you, we put together the best tax strategies to implement now to take your business to the next level. You won't get most of these from your accountant, so like the video, subscribe, and buckle up. Number one is restructure your business to an S corp. Much of your tax liability comes down to your business structure, and that's because not every business is taxed the same. Now, most business owners start as sole proprietorships because, well, it's simple. You literally don't have to file anything with the government besides the general business registration. However, as your business continues to grow and starts to take on credit, liability also increases. So most business owners restructure to a single member limited liability company or LLC to protect their personal assets. However, LLCs don't have any special tax advantages over sole proprietorships. Since you don't have any employer to withhold and pay your Social Security and Medicare taxes, you pay what's known as self-employment tax. This tax is set at 15.3% in 2024. That means you pay this tax on any money you take from your business account and into your personal account, otherwise known as a distribution. Sucks, right? The good news is that you can avoid this tax by simply restructuring your LLC into an S corp. S corps are not subject to self-employment taxes. Instead, you pay FICA, which is 7.65% of the salary you pay yourself. Number two is cut down on your payroll. With an S corp, you have to take what's known as a reasonable pay or a reasonable salary. Basically, this is a salary you assign yourself for skills and services you provide to your business. Usually, this should be reasonable, meaning you should pay yourself what you reasonably pay someone else to perform that same task or that same job. As we explained earlier, you don't have to pay the 15.3% in self-employment tax you otherwise pay with a sole proprietorship or a LLC if you have an S corp. Instead, you only pay what's called FICA tax. However, what your accountant won't tell you is that you don't have to take a huge payroll, it just has to be reasonable. Remember, the goal is to pay FICA taxes on only a small chunk of your earnings and save on self-employment taxes on the rest of your income. So if your payroll is a bit high, you definitely want to be more conservative this year and save on some of those taxes. Number three is unlock your write-offs. Now, the beauty of owning a business is all the expenses you can write off on your tax returns ultimately reduces your taxable income. This includes everything from cost of creating a business, where we're talking about expenses like product and market analysis, or even just traveling to potential sites to launching and organizing that business. But there is a catch. You can't claim these write-offs if your startup doesn't take off. In most cases, small business owners will carry these write-offs into the future until they can actually claim them. So if you're in this category, that is, if you have a business stuck in startup mode, which means you haven't made any money yet, it's time to make a sale. So what I would suggest is be aggressive in making your first sale, be it approaching your close friends, family, or running a huge sale. Once you have made a few sales, you can start taking advantage of those business expenses to offset your income from other sources like your day job. This way, you not only reduce your tax burden by having a lower taxable income and possibly lowering your tax bracket, but also get some relief from running your small business in the tough initial years. Number four is take your equipment procurement deductions. As a business owner, equipment is easily your biggest expense. So if you're looking to squeeze a couple dollars to invest back into your business, this is definitely where you want to pay more attention to. What does this mean? If, for instance, you buy a cargo van for your business and put it to work immediately, you can in fact claim the entire cost of the van on your tax return next year. This is despite the vehicle potentially serving your business for many years into the future. Side note. So also for this situation, Congress is looking at a bill that's potentially looking to bring back 100% bonus depreciation. So as of 2024, you can only write off 60% of that entire business vehicle. So I just want to throw that off that FYI. Now back to the video. The beauty of Section 179 is that you don't have to wait to slowly write off the cost of your business machinery as it depreciates. You can simply claim 60% of the value in the first year. Awesome, right? And this is a bonus tip. Don't forget to deduct those mileage expenses on your tax returns too. That is, even if you use your personal car for work, you can claim up to 67 cents per mile for driving related business. So that said, what else qualifies as a deduction under Section 179? This tax code basically covers different kinds of business assets such as factory, warehouse, machinery, office computers, office furniture, including home office furniture, software, and vehicles with at least 6,000 that weighs at least 6,000 pounds. Now, keep in mind though that vehicles traditionally used for personal use usually don't qualify. Number 5 is claim your QBI deduction. Now, though qualified business income deduction is no longer a new concept among small business owners, many still don't take advantage of it because one, they don't really understand how it works, or two, they don't qualify for it since their accountant hasn't advised them on how to take it. But believe it or not, QBI deductions are available not only for sole proprietors, but also LLCs, REITs, and S corps. Also known as Section 199A deduction, this tax provision allows you to deduct up to 20% of your qualified business income in your tax return. You've saved a whole lot of money with absolutely no explanations. Number 6 is write off your bad debts. One of the most frustrating aspects of owning and running a business is dealing with uncollectible debts. Basically, if you provided a product or service and the client has refused to pay you part or all of the money they owe despite numerous reminders. So what do? Well, you dust yourself off and move on first of all, but there is something that you can do to claim some of these coins back into your business, and that is to claim your bad debts as deductibles when you file your taxes. So if bad debts are something your business has been struggling with, you might want to consider implementing this strategy. Number 7 is deduct your financing costs. When you start your small business, your saving alone are often enough to begin operations. However, as the business grows, so does its needs. Eventually, you turn to banks and credit unions for finances to operate and expand your business. However, loans come at a cost. The most significant of it is interest. But with proper tax planning, you can actually reduce the cost of your financing. How? How, you ask? So really the simplest thing is to deduct interest and other fees on the credit you take for your business on your tax returns. When we say credit, we're not just talking about loans, but we're also talking about credit card debts. That said, some types of credit may not qualify for provisions. So the next time you want to take out a business loan or a credit card, remember to ask whether the interest is tax deductible. Number 8 is leverage software to track your receipts. With proper tax knowledge, most of your business expenses are tax deductible. However, what makes most business owners unable to claim them is the lack of supporting documentation. That's because the IRS requires businesses to keep proof of listed expenses for up to 3 years. So one of the best tax strategies is developing an efficient way to track receipts. And what's better than tracking software? Store all your digital receipts organized in one secure folder and make sure you back them up. As for physical receipts, label them and store them somewhere safe. Trust me, you will need them when tax season rolls by. Unfortunately, this is definitely not something your tax season accountant will tell you unless you ask. So, what other tax strategies have you used for your business? Share with our community in the comment section below. And if you enjoy watching this, like, subscribe, and turn on your notifications for more. Thanks for tuning in. Here's another video you might like as well. Till next time.